Hello and welcome to Market Masters. Billionaire investor Mark Mobius, who's been focusing on emerging markets for over 4 decades. He's a bull on India. Mobius is closely following the tech market in India these days and believes there should be more equity offerings in the country, more IPOs and more listing of government enterprises. And this, according to him, will increase the market size and allow more capital flows to India as well. He's also authored several books on capital markets and the world economy. He's joining us today to talk about his latest book called The Book of Wealth, a young investor's guide to health and happiness. Mark, thank you so much. It's a pleasure to have you on CNBC-TV18.
Thank you. It's a pleasure being with you.
You know, Mark, you write about your own childhood, how you did not come from money or a family of academia either. Your father was a baker, mother a homemaker. You had your own childhood struggles. You never borrowed money because your father warned you against it. Did your own childhood and the learnings guide you as your journey, during your journey as an investor?
Very much so. I think, the teachings of both my mother and father helped a great deal in where I am today. First of all, the value of education was very, very important to them. And they believed that, a good education was something they wanted to give us children. And secondly, they said, never borrow, don't get in debt. And I think those two principles stayed with me and helped me a great deal throughout my career.
Mark, you've also tried to explain investors the true meaning of wealth. It's not about owning expensive cars or having a lot of money in your bank account. It's quite a holistic concept. How did you come to learn about this, and what would be your advice to people who are getting into stock market wanting to earn quick money?
Well, one of the big lessons I learned, in addition to what I learned from my mother and father, was the guru, John Templeton, who I worked with for many, many years. And he was a very frugal person. He did not spend a lot of money on himself. I remember in the office, he used to take scrap paper and cut it and fold it and staple it and use it as note paper rather than buying a notepad. So he was very careful with money, and he was a billionaire. I mean, in fact, he now, after he died, he endowed the Templeton Prize. And in fact, one of the first winners of that prize was Mother Teresa. And the prize is bigger than the Nobel Prize. So I learned a lot from him regarding philosophy of life and the need to be frugal and not to waste money. It doesn't mean you have to not enjoy life, but at the same time, you don't have to waste money. And I think that was a big lesson for me.
Right. Be frugal in your transactions. If I were to ask you the true meaning of wealth, what would that be, according to you?
I would say, number one, wealth is health. In other words, you have to be healthy in order to be wealthy. You're not going to enjoy anything if you're in bad shape physically and mentally. So that's number one. You've got to be mentally and physically healthy. And the second thing is that you've got to be willing to give. In other words, the meaning of wealth is not only to have wealth, but to be able to give it. And that's another important point that I think was a lesson I learned from John Templeton, because he established the Templeton Prize to give rather than to take.
You've also drawn comparisons between Warren Buffett, the Oracle of Omaha, and Rakesh Jhunjhunwala to explain that wealth transcends monetary gains. To gain, you must sustain. Why is this important?
Yes, that's a very, very important lesson that we learn not only from Warren Buffett, but from other wealthy people. In other words, you've got to be able to continue to build your wealth and not necessarily spend it, but to build it so that you can leave it to others. And in order to do that, you've got to be frugal and you've got to be very careful in how you invest your wealth. In other words, you've got to invest in companies that are going to grow their assets rather than shrink their assets. So this is a very, very important element in investing.
Do you also end up seeing a lot of businessmen these days, a lot of investors who are going big on the stock market, not caring about their health? And do you feel that is something we need to really think about?
Definitely. I mean, that's one of the most important points I think I hope that the young people who read my book will get. It doesn't make any sense for you to be running after wealth, running after money, if you're not in good shape and if you ruin your health in the process. So you find that true all over the world. People are so hungry to get wealthy, they forget about their health, and they forget that health is wealth.
Right. You also said that you are your biggest asset. What is the one investment that any investor must make in himself or herself? And what is that continued investment that they should be making?
Well, there are a number of things, but the first and foremost, as I mentioned, is education. In other words, even though you've been to the university, you should not stop learning. One of the things, again, I learned from people that I work with around the world who were successful is that they keep on learning. They keep an open mind. They keep on reading. They keep on learning from other people. That's number one. Keep on learning. Number two, maintain and grow your contacts. In other words, the people that you know are going to be able to educate you about life and about so many other subjects. So try to extend your network of friends around the world. And by the way, I emphasize around the world because you should not be restricted to only your own community or your own country, but you should have contacts all over the world because that will give you another aspect of education, which is so critical today. Because if you're going to find the best investments, you got to go global. You can't do it in only one country.
Right. You've also spoken about different financial instruments in your book. You've compared stocks to bonds. You've spoken about mutual funds. You've spoken about equities, the importance of gold, the importance of cash as well. What would be Mark Mobius's favorite instrument right now?
The favorite instrument is and always has been stocks. Stocks in good, growing companies with solid balance sheets. That is the very best investment you can make to begin with. But there are other good investments like gold. I believe people should have some physical gold. And of course, in order to be successful, you got to be diversified. So you shouldn't put all your eggs in one basket, so to speak. In other words, be diversified across different asset classes. It could be stocks. Of course, stocks would be number one and the best investment, but then bonds, real estate, gold. These are the kinds of ways you can diversify. But I would say 80 or 90% of your investments should be in stocks.
Right. 80 to 90% should be in stocks. What should be the right holding period in stocks, according to you? There are people who want to earn a quick money, but if you want to be wealthy or enjoy the fruits of your investment in the long term, how long should you be with a particular stock in a market?
Well, it depends on the stock and the behavior of the earnings of the stock. Some stocks you can hold throughout your lifetime because they continue to grow, they continue to improve, they continue to adopt new technologies so that they can sustain themselves. But there's some stocks that you buy and you quickly find out that this stock is not going anywhere. The company is not doing well. There have been changes in the management. There have been changes in the industry, and you should sell. So there's no, I would say, no optimal time. On the average, 5 years is probably the horizon you should look at. In other words, when you're buying a stock, you should think about what can this stock do in the next 5 years. Usually people can't, and managements can't look beyond 5 years, but you can get a pretty good idea of where the company is going by looking at a 5-year time horizon. But But that doesn't mean that you shouldn't sell it tomorrow if things change, or that you shouldn't keep it for the next 20 or 30 years if things continue to go well.
Right. Now, speaking about the emotion portion, you've warned investors to avoid the emotion portion in the markets. Avoid a herd mentality. Stay calm. Be knowledgeable. Study the markets well. Study the stock well, and then decide your call. What would be your advice and context in the current environment in India and globally?
Well, you know, in the book, I mentioned the term emotion is the potion. In other words, the markets are driven more by emotion than by intellect or by rationality. In fact, that's the case of our lives. If you look at your normal daily life, you find that so much of it is driven by emotion. When it comes to investing, you've got to be much more rational. You've got to observe emotion. In other words, understand emotion, understand the crowd behavior, and use that understanding to invest. But don't get involved yourself in the emotion of the market. And I remember John Templeton saying the best way to invest is to buy when others are selling, are despondently selling, emotionally selling, and to buy to buy when others are aggressively selling, and to sell when others are aggressively buying. So this is the kind of thing that you've got to recognize when you're looking at a market.
On that note, we are going to take a short break, but don't go anywhere. This conversation with billionaire investor Mark Mobius on his book, Book of Wealth, continues on the other side. We'll also ask him about the recent volatility in the Indian stock markets and the reasons for the heavy selling by foreign institutional investors as well.